Welcome to Wealthfinity, where we believe that knowledge is power when it comes to building wealth. In the world of investing, there are two main approaches, passive and active. While both strategies have their pros and cons, the debate about which one is better has been ongoing for years. In this channel, we aim to uncover the truth about passive investing versus active investing and share insights that will shock you. We'll explore the differences between these two investment styles, analyze their performance, and examine the factors that make one approach more suitable than the other. So, if you're ready to learn more about the truth behind investing and how it can help you achieve financial success, you've come to the right place. Subscribe to our channel and let's start the journey towards building wealth together. When it comes to investing, there are two primary investment strategies that investors can use to grow their wealth: passive investing and active investing. Both strategies have their advantages and disadvantages, and each one may be better suited to certain investors depending on their goals, risk tolerance, and personal preferences. In this video, we will explore the differences between passive and active investing and help you determine which strategy is the best for you. Passive investing. Passive investing is an investment strategy that aims to match the performance of a specific market index or benchmark, such as the S&P 500 or the Dow Jones Industrial Average. This is achieved by investing in a diversified portfolio of stocks or other assets that closely mimic the composition of the chosen index. Passive investing is often associated with index funds, which are a type of mutual fund or exchange-traded fund, ETF, that tracks a specific market index. These funds offer low management fees and are an efficient way to gain broad exposure to a market or sector. Since passive investing does not require the constant monitoring of individual stocks or assets, it can be a lower maintenance approach to investing, making it a popular choice for many investors. Active investing. Active investing, on the other hand, is an investment strategy that involves constantly researching and monitoring individual stocks or assets with the goal of achieving higher returns than a market index or benchmark. Active investors often rely on their own research, analysis, and market insights to identify undervalued assets or stocks with high growth potential. While active investing can potentially generate higher returns than passive investing, it requires a significant amount of time, effort, and expertise. Active investors must constantly research and analyze market trends, monitor the performance of individual stocks, and make informed decisions about when to buy and sell assets. This can be a high-maintenance approach to investing, making it more suitable for investors who have the necessary knowledge and resources to devote to this strategy. Which strategy is best? When it comes to determining which investment strategy is the best for you, there is no one-size-fits-all answer. The choice between passive and active investing ultimately depends on your personal goals, risk tolerance, and investment style. Passive investing may be a better fit for you if you are looking for a low-maintenance, long-term investment strategy with a lower level of risk. This approach allows you to diversify your portfolio and take advantage of the overall growth of the market without having to devote significant time and resources to research and analysis. On the other hand, if you are willing to take on more risk and have the expertise to actively manage your investments, active investing may be a better fit. This approach allows you to potentially generate higher returns than a market index by identifying undervalued assets or stocks with high growth potential. Ultimately, the decision to pursue passive or active investing should be based on your personal goals, risk tolerance, and investment style. It's important to do your research, consult with a financial advisor, and choose an investment strategy that aligns with your long-term financial objectives. Investing is an excellent way to grow your wealth over time. However, there are two primary strategies for investing: active investing and passive investing. Both of these investment strategies have different approaches to investing, and understanding the differences between them is crucial to making informed investment decisions. Active investing. Active investing is a strategy where investors attempt to beat the market by picking individual stocks, timing the market, and making frequent trades. Active investors believe that they can identify undervalued or overvalued securities that the market has not yet recognized. They use research, analysis, and market trends to make investment decisions. Active investors typically have a more hands-on approach to investing, which requires a significant amount of time and effort to research and monitor their investments. They also tend to incur higher fees, as they often trade more frequently and pay more for research and analysis. The potential benefit of active investing is that investors have the opportunity to outperform the market and earn higher returns than passive investors. However, it's important to note that active investing also carries a higher level of risk, as the potential for significant losses is greater. Passive investing. Passive investing is a strategy where investors aim to match the performance of a particular market index, such as the S&P 500. Passive investors believe that the market is efficient and that it's challenging to beat it over the long term. Instead, they seek to replicate the market's performance by buying a diversified portfolio of securities that mirror the composition of the market index. Passive investors typically have a more hands-off approach to investing, which requires less time and effort. They also tend to have lower fees, as they trade less frequently and don't require as much research and analysis. The potential benefit of passive investing is that investors can earn the same returns as the market with lower risk and fees. However, it's important to note that passive investing may not provide the potential for outsized returns that active investing can. The main difference between active and passive investing is the approach to investing. Active investors attempt to outperform the market by picking individual stocks and making frequent trades, while passive investors seek to replicate the market's performance by buying a diversified portfolio of securities. Active investing carries a higher level of risk, as investors are more exposed to market volatility and the potential for significant losses. Active investors also tend to pay higher fees, as they often trade more frequently and require more research and analysis. Passive investing, on the other hand, carries a lower level of risk, as investors are essentially betting on the long-term performance of the market as a whole. Passive investors also tend to pay lower fees, as they trade less frequently and require less research and analysis. In conclusion, the debate between passive investing and active investing is a complex and ongoing one, with both sides offering compelling arguments. While the idea of outperforming the market through active investing may be alluring, the truth is that it's challenging to consistently beat the market over the long term. On the other hand, passive investing offers a reliable and low-cost way to track the market's performance, providing a more predictable return on investment. Ultimately, the decision between passive and active investing should depend on an individual's investment goals, risk tolerance, and time horizon. It's important to consider all the factors and do thorough research before making any investment decisions. As with any investment strategy, it's crucial to stay disciplined and focused on long-term goals rather than trying to time the market or chase short-term gains. By doing so, investors can set themselves up for long-term success and financial security.